Without further ado, I'd like to invite Yannic Blais-Gauthier pour introduire notre prochaine session. Yannic, the podium is yours. Thank you very much.
Thank you, Vanda. Bonjour à tous. Good morning, everyone. My name is Yannic Blais-Gauthier. I'm the partner in charge of the Financial Services Risk Management practice at EY. It's my privilege today to introduce today's discussion that is both timely and critical, the speed of change in risk management. In an area where the velocity of change is unprecedented, risk management has an important role to enable organizations to navigate through an ongoing changing landscape. The agility in which we identify, assess, and respond to risk is no longer just a competitive advantage, it is a fundamental necessity. We're here this morning to explore how chief risk officers can navigate through this changing and challenging risk environment. Our CRO panel today includes Kathryn Fric, CRO at OTPP, who has had progressive roles in credit and risk management functions across Sun Life, Citibank, and Deloitte before joining OTPP as its CRO in 2021. Welcome, Kathryn. Jean-Sébastien Grisé, incoming CRO at National Bank of Canada, who has had senior risk management roles in both National Bank and GE Capital over the past 20+ years. Welcome, Jean-Sébastien. And Halina Hagen, CRO at Manulife, who has held progressive executive roles at RBC and Manulife across treasury and risk management function. Welcome, Halina. Thank you for joining us today, and thanks in advance for sharing your insights. These industry leaders will share their perspectives on some of the key risks that we're facing today and how they're impacting business models and organizational strategies. Without further ado, let us hear from our panelists and learn how we can chart the course for a more resilient tomorrow. Thank you for your attention. I'm looking forward to a stimulating and insightful discussion. The panel today will be moderated by Nez Aquino, Chief Operating Officer at GRI. Nez, over to you.
Great. Thanks very much, Yannic, and good morning, everyone. So I will be asking our panel some prepared questions. Again, throughout the session, feel free to submit your questions. You don't have to wait till the end, and we will weave them into the conversation today. So the theme of our discussion today is adapting to speed of change, and it is very timely. And when we selected this theme, we hadn't yet had the events of the last 48 hours where the world is rapidly changing compared to, even before then. And we just heard from Ambassador Rice on all the geopolitical risks that are just coming fast and forward to our environment as well. So I want to bring us maybe to our organizations and to our sector for a second from the geopolitical side of things. The financial sector is navigating an incredibly complex, a fairly interconnected and somewhat volatile risk landscape, more so today than we would have said 5-8 years ago. I think it's fair to say in the post-2008 financial crisis, we all buttoned down the financial risk management practice of our organizations. It was a good reminder of going back to the basics of risk management. In the last 5 to 8 years, when I look at the landscape, I think there has definitely been an emergence of fairly new risk stripes, new risk dimensions, or those that were in our lexicon have definitely gained in prominence. So, the potence and significance of cybersecurity threats. The way we think about third-party risk management today is different from the way we thought about it 5-8 years ago. Climate change is a relatively new risk dimension in our world. So as CROs, when you look at this landscape with the eagle eye view, which you are required to do in your jobs, and when you step back from it, what is a scenario that you dread the most? What is a scenario that you hope never sees the light of day? And how do you prepare the organization for that unlikely but probable event? So Kathryn, I'll start with you, and then we'll go around.
Sure. And I'll say, as Chief Risk Officer, to state the obvious, I worry about a lot of different risks across the organization, pretty much the whole span. And that would include a lot of the operational risks, so everything from, third-party cyber, technology, et cetera. And those risks are critically important. They can really impact your ability to protect your clients' data, to service them appropriately. They can impact your reputation. And importantly, they can also really take a significant amount of bandwidth to manage. If something goes wrong, you can spend a lot of resources managing those operational risks instead of undertaking things that are more strategic for the organization. But I'm going to give you probably what's a little bit of a boring answer, and that what really worries me the most continues to be the financial risks, because those are the ones that can really impact the sustainability of us as a fund and impact what's really our core mandate, which is the financial security of our members. So when we're thinking things like geopolitical scenarios, et cetera, I worry about how those would play out. So how do we prepare for those as an organization? Obviously, we spend a lot of time on thinking about things and doing things like stress testing and scenario testing. And we really spend a lot of time scanning the environment on how the environment's changing, and we account for that in the scenarios that we're running and testing. A lot of it really comes down to, too, how do we think about the resilience of our portfolio? So how do we manage the liquidity, the wide range of capabilities we have to invest across asset classes, having the agility to be able to pivot our portfolio quickly if needed, and how do we think for that? I will say, I do think for me the biggest impacts of the complexity of the environment that we're operating is that even if we call the scenario right, and what we think is the worst case scenario could happen, we're often able to maybe see those first order impacts, but it's very, very difficult given the complexity of what we're working in to see what the second order impacts or third or fourth impacts are going to be. So that's really, to me, more about making sure both the portfolio and the organization is resilient to react for the things that we can't predict, because we're not going to be calling it fully right. And one example I can give you from this comes more from my insurance days, where, before a pandemic, obviously a pandemic risk was something that all insurance companies are thinking about. But when you think about it from a scenario perspective, you were thinking about it more from a significant loss of life in a working age population perspective. You weren't really picturing economies around the world shutting down and sending people home for 2 years, and what that would do to supply changes and mix of services versus goods, excess savings, and how that would take multiple years to work its way through the system. So I think that is true about many of the risks that we're managing now. It's going to work its way through the system in very unanticipated ways.
Thanks, Kathryn. Jean-Sébastien, you're the incoming CRO of the 6th largest bank in Canada, so how are you preparing for day one and beyond?
That's a question, I think.
Yeah,
but,
yes. I'm trying to read that.
But I think Kathryn really covered it well. The financial risk remained top of mind, and for banks, it's always liquidity and credit. But you can really well prepare and structure yourself to be resilient to face those. So I think I'll jump and I'll go a bit in a different place. Financial crimes, I think, is something that we're very focused on right now, and specifically AML. We've seen fines that are very important and can have a big impact on the brand and the brand value of a bank. So that's something we're very focused on. And FATF, which is kind of the regulatory entity on top of FinTrack, is coming to Canada in the coming years. And we're expecting some rollover from that and some impact. So that's what we're focusing on. And as you mentioned, the easiest way to manage risk normally is to reduce complexity, but complexity of our organization is growing exponentially. So it's making sure that you rely on great frameworks and on great people to try and keep risk management simple, even in a complex environment.
Yeah, we will definitely spend some time on financial crime in a second, but thanks, Jean-Sébastien. Halina, how does this look in the insurance space for you?
So I was reflecting on what my panelist colleagues here expressed, and I would say that while the financial risks are absolutely important, it matters for like how much capital strength you have, the resilience of your balance sheet, liquidity, etc. I would say that the focus there from our perspective is to maintain the strength and understanding, but my concern is much more shifted towards the non-financial risks. And the reason is that on the financial risk side, there are established methodologies, experiences, practice, how to measure those risks, how to identify them. Linkages are quite well understood and sometimes, unfortunately, experienced, including the second and third order impacts. There are well-established market available risk mitigation tools to address those risks and keep them within our respective risk appetites. So they are absolutely important. I don't want to say, oh, we are done with, and we know the foundation of the house has to be maintained, but I am much more concerned with non-financial risks where like the methodologies for identification, measurement, thinking through the linkages are not as well understood and tested. And what I fear most is actually what I have not thought about it yet. How do we reduce this fear of unknown? We do regularly comprehensive stress testing and tabletop exercises, and I find them extremely valuable in thinking through how various elements of the scenarios could be unfolding and how they are connected, and also thinking through what we would do. And actually the best moments are those moments when you come to a certain intersection and it's not clear who is making a decision or what should be done, because they are just the most insightful in strengthening our understanding of where we want to be and how we should operate. So I find, of course, the real life situation will never evolve how we think. But it's not the point here. The point is that when we go through those exercises and we develop jointly the brain pathways in many ways on how to recognize the linkages, how to think of situations, to strengthen our readiness on addressing the shock as it evolves, it's super valuable to face then the real life crisis, because you already prepared yourself for many angles of it. Not every angle, but many angles. But I would say once we can think of something, we can then start wrapping it together, understanding it better, etc. It's all those, given the complexities, and we heard in the earlier session of today's world, and what we heard here about the third party and operational and all those cyber financial crimes, etc. How to recognize that one needs to be so vigilant in terms of consciousness on what else can happen and think it through.
So maybe I want to take the non-financial risk side that you highlighted very well, Halina, and bring it back to you two on. So when we look at again, financial risk management, non-financial risk management, there is definitely no shortage of guidelines coming from OSFI and other regulators about the way we should think about operational risk and operational resilience. But then in a way, because they're so complex and not maybe as black and white, not easy to model as we are used to doing the ALM modeling and credit risk modeling. Do you think we have even the right tools today to manage? Are we equipped properly to manage the non-financial risk side of our business? Or what needs to change in our industry to get us more evolved and mature as we are in managing some of the more financial risk side of the house? So maybe Kathryn, I'll come back to you, and then to Jean-Sébastien to hear your thoughts.
Sure. So I would say, I agree with a lot of Helena said on the non-financial risks are a lot harder to wrap your hands around. It can be harder for people to express a risk appetite. What I find to be one of the trickiest aspects about them is they can often, in certain instances, be so dispersed across the organization that even getting a fulsome picture of the risk can be a challenge. But in particular, finding the one person you can point to and say, you're accountable for this risk and we need to be doing better here is a lot trickier at times in the non-financial space. I do think there are tools that are becoming available more and more, including AI tools, third-party providers that can support information, et cetera. But I do think, we've got a long way to go, and it's not easy. As you're saying, it's a lot of unknowns without a lot of data at this point in time. I think one of the tricks for me on managing non-financial risks better is really recognizing that they are as interconnected as they are. So historically, a lot of these programs were run as kind of standalone, pseudo-siloed programs, like third-party risk was managed in one way, and cyber was managed in a particular way, technology was managed in a way, et cetera, business continuity. So the more that we recognize that because these risks are so interconnected, that the risk programs need to be interconnected as well, I think the better off we'll be over time.
Jean-Sébastien, what's your take?
Yeah, so I think we have the tools. I think we have the frameworks. I think we just need to live with them a little bit longer. So when you look at the history of, credit risk, for example, it took time before we developed models, before we understand that the PD, the LGDs, the EL. It really took time, and it took data, and it took KPIs, and it took refinement over years to arrive to something that looks so pure and simple. Well, I'm pretty sure that you're going to look at different types of non-financial risks, and you're going to not be able to distill them as simply as credit risk, but you'll be pretty close. I think right now it's really a measurement challenge, and making sure that each organization finds which KPIs are really, really important for them to follow. But also, I think we like to operate in complexity, and there needs to be a little bit of a shift here. We are told all the time that financial risks are complex. Yeah, yes, they are, but the frameworks to address them don't need to be complex. And if you have simple policies, simple frameworks, and you explain them well, I think you can get 80% of the way there.
Oh.
If I may add, I came into my role 1.5 years ago from being a head of capital, so very focused on financial risks, and had to expand my knowledge and understanding of non-financial risks. And I have to say, I was positively surprised how much structure there already is in terms of what we call information risk management or cybersecurity. There are actually well-established frameworks, such as of a National Institute of Technology and Science and Technology, and with many KRIs, how to measure various aspects. And there are industry benchmarking, etc. So this gave me a lot of optimism that as those risks evolve, also our tools on how to structurally approach it. So I see more than, I say, like the previous was a decade of cyber, and it will remain very important, just as financial risks are. But now is this decade of operational risk, resilience, the continuity of our operations in face of disruptions. But even there is already a lot of structural thinking, frameworks, approaches, KPIs. It's still evolving. And you mentioned regulations. I actually think in this context, regulations or OSFI guidelines are very helpful, because they bring together a lot of market intelligence that regulators hear from all of us jointly. So in a way, it brings together the best of practices and thought leadership in our respective institutions, and it also prompts us to think of aspects we might not have had. So I think the regulations actually play an important role in helping us to structure our thinking around those risks.
Yeah, and completely agree, because these regulations are also not new per se. They are just a very comprehensive update based on all the intel to what we had in a thinner format perhaps several years ago. I want to switch gears for a second to financial crime. We have a number of questions also coming from the audience on financial crime, so let's spend a few minutes on that. It's a little hard to spend time with CROs and not talk about the rise of financial crime. I think every organization is struggling with that. So I want to ask it, I guess, from two perspectives. The first one is there's been ongoing debate and shifting lines between where the consumer liability begins and ends and where the financial institutions liability begins and ends when there is a financial crime occurring to a consumer. I'm talking about scams like romance scams and those sorts of things. And so maybe Jean-Sébastien, I'll start this question with you. And then connected to that, while you're thinking about that, there's also, as a result of the rising power of AI, both the hackers are, of course, at an advantage, but how are the organizations using the deployment of AI to fight with financial crime?
So there's a lot of questions in there. I think on the liability framework, I think the core of it is the financial institutions need to do the best they can to protect you from taking wrong decisions. You can't protect from stupidity sometimes, but you need to put as many safeguards as possible to protect your clients. Because you're right, the frauds and the scams are getting very, very sophisticated. You know, voice scams, people now getting pictures of their house taken and sent to them and say, we know what you do in there, send us crypto dollars. So as a financial institution, I think it's really in the payment area, you need to educate your clients onto where are they sending money, right? And there's many technological ways to do that. On your question on AI, so I think that it's evolving very quickly, and what you can get on the dark web is absolutely mind-boggling, especially in imitating voices to do customer identification. So as a financial institution, you really need to keep on top of that. And we always had kind of a view of how can we make the customer experience as frictionless as possible. I think that is changing. It's how do we make the customer experience with an equilibrium of frictionless but protection.
Yeah, thank you. Kathryn, anything you want to add?
Well, I'd say our footprint probably looks a little bit different, just given the nature of our business versus others. But we do administer the pensions of our plan members. So that does expose us as well to needing to protect our plan members from potential financial fraud if people try to move money out of their account, for example. So I wholesomely agree that it really is about how do you support your membership in making their experience frictionless and what they need to do to transact, yet at the same time ensuring that there's appropriate protections in place to the best of your ability. To prevent actions that would otherwise occur. Yeah, so.
This is also a big focus area for us with ever-developing tools. We've been just implementing the next wave of multi-factor authentication for internal purposes, a multi-stage. So I understand it's an industry-leading application right now, and it. Based on our thinking, it also boils down to being absolutely rigorous about knowing your customer, the behavior of our sales force, reinforcing the compliance throughout the organization. And as you mentioned, AI is actually hugely beneficial because it very quickly can map patterns, like sort of, as you know, the insurance products and services are distributed through third party, the agency, the bank assurance, brokers, etc. So it's not only about monitoring behavior of our employees, customers, but also our distribution force. And again, AI can very quickly take many data of the customers and map it, like to check whether, for example, it's the agent's address that appears on 5,000 applications, or the same phone number, like on seemingly different branches, etc. Like, so I think the use of AI, as much as it creates its own risks, it also can be is a very powerful tool in detecting the risks and mitigating them.
For sure, and again, there's a lot of theory about the fact that there's lots of success stories. There's also theory that it takes a lot of capital before we reap the benefits, and so I think we will continue to be in this evolving AI space. I want to switch gears for a second and bring us to the macroeconomy again. It's hard not to talk about macroeconomy when we're sitting with CROs. I think it's safe to say that Canada has now safely entered a moderate level of inflation. It has registered under 3%, the headline inflation, every month this year. And we have seen the Bank of Canada moves as a result of that. Here in Canada, 75 basis points move in 3 successive states. US Fed decreased in one move 50 basis points earlier this month. Unemployment is still inching up. It's gone to 6.6% in August, which is a whole percentage point higher than where we were a year ago. And I think we would all agree the consumer out there is feeling the cost pressure in everyday expenditures for sure. So in the midst of all this, from a consumer behavior point of view, what do you see differently in your business models and outcomes? Maybe I'll take this question with Jean-Sébastien and Halina. And Kathryn, I want to finish with you from an interest rate perspective. How is this environment different than where we came from? Because we've been a bit of an up and down. And maybe you can speak to how that impacts your portfolio. So
I'll start?
Sure, yeah.
So maybe if we go back like a year ago, I think if we were all to sit down, everybody would be talking about housing. Everybody would be, there's a big wall coming. It's going to be difficult. Delinquency rates are going to go through the roof. Values of houses, are going to go down. So what we've seen in the past year is actually quite encouraging. And I'll use our bank's example. So around 60% of our mortgages have been repriced. So that's the variable rate plus the fixed rate. Our variable rate mortgage have a payment that vary according to the interest of the interest rate. So you can really see the impact on clients. So what we've seen with clients with mortgages is they have curtailed other type of spending. So we've seen very, very prudent behaviors by the Canadian consumer in general. There are some geographical differences. We're seeing that Quebec seems a bit more shielded than rest of Canada because of lesser leverage, but not that big of a difference. Where we're starting to see differences and holes is everything regarding unsecured credit. So the biggest driver for unsecured credit is unemployment. It is 6.6%. It has increased a lot in the past year. But what's really interesting to see is unemployment is an aggregate value of a lot of things. But when you dig a little bit more, you'll see that there's cohorts of the young people under 25 had an unemployment rate of close to 14% right now. Right? These are not homeowners. So what we're seeing is obviously unsecured credit now has normalized and is what we call levels of delinquency that are over pre-pandemic levels. It's a new term that we use now, bankers. And when you dig down a little bit more in this, you see there's a big difference between homeowners and non-homeowners. So homeowners that have unsecured credit are fine. Non-homeowners that have unsecured credit are having a tougher time. And in that cohort, the younger population is suffering more.
Yeah, maybe I'll just follow up quickly on that. What about the business side of things? Because one of the, again, pre-pandemic, post-pandemic distinction is in major cities, office vacancies have risen and stayed there pretty much across the country. How is that, and given that we still continue to have pretty robust hybrid work practices across the country, give and take, with different practices in different industries, how do you see that playing into the commercial side of things?
So if it's more on a commercial, a CRI type of question, well, then the question is how much office do you have in your portfolio, right? And all banks have different positions on this. I'm happy with the position National Bank has on that. But what we've seen in general is we've seen insolvencies rise in terms of the of corporate and commercial credit in the past years. It has been kind of a mixed bag. There's the end of the CEBA program, which obviously caused some insolvencies. Some people didn't want to repay, filed. So that did kind of a little bit of a blimp. Came back down. But I think we're going to see still more duress and insolvency if the interest rates continues to stay at the level that they are right now. So maybe you'll handle that.
Yeah, actually, maybe Halina will hear from you, and then we'll come back to Kathryn at the end. How is this environment affecting, from a consumer perspective or from your business outcome perspective?
So I would like to distinguish between the macroeconomic variables and the behavior of consumers. And maybe I start with the latter. So in order to understand what drives our business, like it's important to see the motivation for which we enjoy the demand for our products and services, and it can be divided into two categories. broad categories. One is what I would call protection against sickness, against life, like the death, etc. And then wealth accumulation, wealth protection that's more connected to the economy at large. So in the first category, we, even throughout the pandemic, experienced a lot of resilience in demand for our products and services, because one may say that those events actually underscore how important it is to have insurance, life insurance, disability insurance, insurance against sickness, and similar. So as such, there is a lot of resiliency in that business, maybe even similar to what you mentioned on the housing side. People don't lapse policies readily, like they want to maintain the coverage, especially when there is a lot of uncertainty and risks. So, and the insurance business, which we like to underscore, unlike banking, is a very long-term business, and hence we don't experience like massive lapses, even if there is a macroeconomic downturn, and as such, it's in a way complementary business to banking from the sensitivity perspective, which brings me to the macroeconomic resilience, because it may not be always fully appreciated that my company Manulife, together with almost all global insurers, life insurance I know of, actually hedge very actively their macroeconomic exposure. So it's in our disclosures, our sensitivity of our earnings to interest rate movements is essentially zero. Sensitivity of our capital to interest rate movements, it's minor, it's like 1 point, like so for 50 basis points plus or minus interest rate movements. So yes, there are convexities in our liabilities, but even then, overall, the balance sheets of insurance companies are fairly resilient to the macroeconomic changes, because we all learned from the great financial crisis and instituted very sophisticated and tested infrastructures of hedging methodologies that keep us in a strong position regardless of the durations of markets.
And Kathryn, you are also, of course, in a business that has a very long-term view. So what is your comments on the ALM side?
Also how it plays out in an insurance company or in a pension company is a little bit different, because obviously it's impacting both the asset and the liability side of our balance sheet. And on the liability side, it's also what's happening in reality versus what you actually have assumed for the very long time in your liability structure. And obviously, interest rates also interconnected with inflation. So I'll start a little bit with inflation, then move on to interest rate. But the way inflation really impacts us as a pension fund is in two directions. One being that the pensions that we're currently paying out, so our pensions and pay, are indexed to inflation. So when we're undergoing periods of high inflation, the cash payments that we're making every year and what we're assuming in our liabilities is increasing. But it will also affect us over time as inflation gradually, to some degree, will make its way into wage increases. So with those wage increases, your long-term liability assumptions also start to increase because obviously teachers would be ending with a higher wage than they would otherwise have been ending with if you'd been in a lower inflation period. So our liability structure is going to naturally be exposed to that. On the interest rate side, it impacts us in a host of different ways. Obviously, we have our asset portfolio, some of which could be in fixed income or credit, but we are able to also manage that very tactically. So we have long-term strategic goals for our portfolio mix, but we will also move in and out of that at times aggressively and tactically based on the value we see in various asset classes. Interest rates will also impact us, for example, through the fact that we use leverage ourselves as a pension plan. So we have synthetic leverage through derivatives. We have long-term debt and short-term debt that we take on in order to appropriately diversify our portfolio and get kind of the returns that we need in the best risk-adjusted way. So that will impact us. Higher interest rates also will impact our portfolio companies that are using debt. So in private equity, for example, you'll see that come through in higher cost of companies, but also potentially in less leverage Interest rates, as well as where equity markets are trading, are also taken into consideration when we're looking at valuation of assets. So we'll see that come through on the asset side of our balance sheet. And then finally, I'd say higher interest rates, in particular for us, real rates, over time works its way into our discount rate as well. So obviously higher rates means a higher surplus, all things else being equal for a pension fund. But underlying that assumption of a higher discount rate is the assumption that those higher real risk-free rates mean you should be able to either earn the same asset returns at a lower risk level, or you're able to keep your risk level the same and earn a higher asset return level for a very, very long period of time, which may or may not turn out to be accurate assumptions.
Thank you. Thanks for that. We have a lot of interest from the group on climate, and this was one of the points that we were going to discuss, so maybe we'll switch gears toward climate risk management side. I think to wrap up all the questions coming here on climate, the interest seems to be, it's a bit easier to understand and what to do about managing the physical side of climate risks, and you're more than welcome to add comments on that. But what about the transition side of things? How have your organizations approached what it means to you, your investments, your balance sheet, your consumers, to manage the transition risk for climate? We can go in any order this time.
I do? Okay.
Okay, Halina.
So again, the broadly defined sustainability agenda is very high on our mind, but from a CRO perspective, it is not a major risk for the life insurance company, because unlike P&C companies which are facing climate events and consequences of those events on claims that they need to pay, we largely do not have such stresses that can unsettle or challenge our financials, because and I don't want to sound callous here, but even mortality events related to climate incidents in the aggregate and on a big scale for any big life insurance companies that tend to have diversified portfolios across various regions, jurisdictions, etc., those would not be material impacts. So, and similar to any morbidity events, sickness, these may transpire through time. We may see consequences and recognize them once we have years and years of experience to do so, but otherwise on our insurance risk portfolio, it is not a major risk. So where the focus is in our what we call general account or our investments, which would be possibly similar because we hold a variety of sectors. Being in Canada, we have some, although very minor, less than 1% of our assets exposure to oil and gas, for example. But because we are a long-term player, we've also been investing for the last 3 decades in sustainable assets because it just fit the profile of our cash flows. On the liability side. So we have like around $50 billion, 10% of our balance sheet in solar energy, commercial wind farms, etc. We are the biggest or among the biggest institutional managers of timberland in the world, etc. So that's why it's sort of being life insurance companies, we are very much vested in well-being long-term of our customers, society at large. So there is a natural alignment with the focus on the environment, climate, etc. But it's not a risk that we directly face on a major scale. So it may sound a bit blasphemous from the stage, but I will dare to say so, that I view from a CRO perspective that the major risk pertaining to climate arises is a regulatory risk, given the amounts of regulations, requirements, disclosures, controls that are needed around it, reputational risks around it. This is where the key risks are on the climate side for us, as opposed to the real evolution of weather patterns and similar.
And by that, Halina, do you mean like we don't have enough regulation yet, or
no,
there's too much? I think you mean the other side.
We have a lot of regulations, and sometimes, you know, the measurement of climate impacts, which we are asked to be disclosed, are not that robustly defined. So this is the challenge.
Yeah. Sebastian,
I think that's very complete. I think the only point I would ask is, you know, there's kind of two challenges here: is how do you help your clients through transition risk, and how, as a bank, you protect yourself against clients who will go through transition risk. And the key here is to understand what's the biggest driver of transition risk. Well, it's your footprint. So being able to quantify and help your clients quantify their footprint. And as a bank, having simple and robust ways to know which part of your portfolio is more carbon intensive versus the one that is not carbon intensive. And instead of spending time trying to go to the third decimal point, is going on the big, you know, the big chunks of it. Making sure you manage well and you continue to support your clients through their transition, but that you diversify your own portfolio also.
Yeah, and I can say, you know, obviously we're a very long-term investor. So we were very early adopters in our space with respect to climate change and sustainable practices. So in 2021, we established our net zero goals for 2050, and that included some ambitious interim targets. So we're currently tracking well to meeting our 45% reduction in intensity by 2025. And we also continue to invest in green assets and are just over about $32 billion now, so to continue to track well on our targets there. And the underlying reason for that is, as long-term asset owners and investors, we really do believe that it's the best way for us to meet our mandate on the long term, that sustainable companies will continue to outperform and that there's good opportunities on investing in this space. What I will say, just to give a bit of a different lens to it too, is I also look at climate risk from other sides, in that I believe it's quite strongly that it's an amplifier of other risks that we are facing. So how do we look at those interconnections? So an example of that would be, you know, climate change is requiring a very expensive transition with a lot more of that to come. And that has impacts on inflation, it has impacts on equality, it has impacts on regulatory risk as customer bills go up, for example. To me, it amplifies a lot of what we're facing from a political perspective and a geopolitical perspective. If you think about things like the potential for mass migration of individuals, needing to have access to fresh water, fresh air, fresh food, and the inequalities that already exist between, you know, those that are producing carbon and those who are going to be impacted by it over time. So like I said, to me, we really have that need to think of it as an amplifier. And expect greater volatility on a number of different realms going forward as a result.
There's a number of questions coming from our audience, which I will wrap up into one question, and it is really about this notion where we started from. In the midst of complexity, I think Einstein said this, in the midst of chaos, find simplicity. So a bit like, how do we go back to basics, and how do we cultivate risk-aware cultures from the risk suite of things to the organization? Can you speak a little bit about that? I mean, there's, again, guidelines coming on risk culture, what risk culture means, et cetera. But how does that manifest itself in your organization now and in the future? Yeah, sure.
I'll take my turn starting. So I'd say you can never overemphasize the importance of a strong, rich culture in an organization of the nature of the types that we're running. And there's all the, you know, the more classic ways of ensuring that you have a great risk culture, and that's everything from really good governance structures, well-defined authority levels, being able to know who the decision maker is, having a culture that is able to measure the results of the decisions that we make and hold ourselves accountable for them so that we have the ability to learn and to grow from those things. But there's a couple of things I can just point to from my perspective that are very important to us having an important risk culture. And one is really supporting that cultureness of openness and speaking up. So regardless of an individual's role in an organization, everybody feeling comfortable asking questions or bringing up concerns. So a very small example of how we go about engendering that I can give you is the recent move to our new office buildings here downtown. We have moved from North York to the financial district after many years and fully moved in this summer. So when we were designing our new building, one of the things we did is make the decision to have almost nobody in an office. Now, there's a lot of different reasons we made that decision, but one of the key reasons for us is it's all about accessible leadership. So, you know, I sit on the open floor with all my people and the investment team, et cetera. It's a lot easier to ask a question or bring a problem to somebody that you see every day, that you've had a conversation about what are you streaming on television, than it is to go up 2 floors, knock on a half-closed door and speak to somebody you don't regularly get the chance to speak to. So we really are trying to create that very open and curious culture. In fact, in our new building, I see our CEO regularly eating in the cafeteria at a table anybody can join. So, I don't think you get a lot more open than that. The other thing that I think is very important to me from a risk culture perspective is we've got really good, strong second lines. And it's important to me that we continue to fully embed them in the organization. And embedding them to me means also ensuring that they're there near the start of things rather than coming along at the end of things. It's important for us to be able to influence some of the decision and aid in some of the decision making early on, rather than being, coming in late and being the people who are simply opining yes or no on things.
Can I add
sure.
things to that? So, yeah, great. And I'd add 2 things. So leadership, so making sure that the tone, not at the top, but at the tops, is very well aligned and a clear risk tone that is easily understandable by everybody. And the second thing is an ownership mentality by everybody. So, and I think an example of this is not having a sales culture, but having a business ownership culture where everywhere, especially the first line, they own the entirety of their risks, not just one KPI. So I think also in terms of organizational design, the way that you pay people is really important, that it not necessarily be paid on volume targets, but more on profitability, on customer satisfaction, to make sure you drive the right behaviors.
I wanted to add something. I agree with all the comments here. When I took on my new role, our CEO said to me the following: we have aspirations, we have growth ambitions, we are very dynamic organization. I want to run fast. Your job is to ensure I don't strain my ankle, I don't break my leg. So this was actually a very powerful statement of authority, accountability, that we are not an obstacle in constraining that run. We want to make it sustainable. So once this tone is set and we feel this way, we are not there to say no, we are there to protect and to find ways of making to that top, us making jointly to where we want to go. I just love this image because it hugely validated in a constructive way the role. Another aspect that we've introduced recently, which at all levels of the organization, is formalizing a role of a challenger. So you sometimes have those big and sometimes smaller, but big, major strategic discussions, conversations where to go. And to anchor with someone, you are to be a voice of dissent, Kathryn. So your job is actually to crystallize what's what may be problematic, what may be of concern, and it's a legitimized role. So it's not, because we sometimes tend to seek consensus, we want to get along, etc. Like, so how do you break through the risk of groupthink? And you encourage those voices with alternative points of view, and you legitimize them as part of the culture, I think is critically important.
All very well said and all very relevant in the management of risk. So thank you. Maybe we're going to begin to close it down a little bit. And I want to pose this question for you. So I think, Jean-Sébastien, you said this like last year or the year before, we were all talking about housing and what's going to happen to the mortgages and interest rate risk that goes with that. It's a little bit quiet now as that is landing, hopefully softly. And this year, of course, there's going to be a whole session on AI after this, and we talked about AI a little bit. If you fast forward a year or two from now, what do you think will be changing in the lexicon we talk about risk? What will be rising more prominently to the risk discussion? And how do you think you can prepare your organizations for that event or for that risk dimension? I think housing will always be there. I want to just call that out. We will always be talking about housing, but
so
other
maybe
than that.
I jump first. I think what we today call operational resilience, and we are trying to build our understanding and requirements around it, will be like a matter of fact necessity. And I just wanted to take a moment to distinguish, because how I think of operational resilience. So cyber is, you want cybersecurity, you want to ensure no one breaks into your house. And if they do, they cannot get to bedrooms of the children, etc. Like, so you limit the mobility within. Operational resilience, it's a different question, is if your water supply breaks down, how do you still keep going? And that's the expectation of customers, shareholders, regulators, that you keep going. And it's an unsettling question because it's this dependency on third parties where you don't fully control, where you have to trust. You can have frameworks, you can test them, but how there's a balance between how intrusive you will be allowed to get relative to your own need to ensure that your reliance on a given third party is properly tested and assuring. So to me, the operational resilience, this need to keep going, and I don't know whether you saw a few months ago, there was a huge breakdown, a ransomware attack in the United Health, big US provider, where millions of customers were left without access to prescription drugs, scheduled medical appointments, share price collapsed 20% in the course of a few days, etc. Like a major event that sort of shakes us all, because that's exactly what operational resilience should protect us against. So I think 2 years from now, I think we will be all in a better state when it comes to this specific aspect.
Sure, I can go next. I would say, I think what we'll be talking about 2 years from now will be a lot of the same, if I'm perfectly honest. I think some of the trends we're on around the end of hyperglobalization, greater politicization of issues, et cetera, are going to continue, and we'll continue to experience the fallout of all those items. One thing I would say that I assume we're going to be talking a lot more about 2 years from now is AI. Because we're obviously talking about it already an awful lot, but I don't think any of us have a really good feel for exactly what the rate of change is going to look like, the pace of change, the extent of change, et cetera, and how that even could be limited by things like the ability to supply water and power and the other core kind of underlying physical things that are needed to keep up the pace of change. So I'm imagining that we're in a position 2 years from now that we have a better feel for what that pace and extent is going to look like. And we may also be in a position where we've had some challenges crop up that regulators and others are having to deal with and think about more. So I think we'll start to get more clarity on some of these issues over the next couple of years.
Jean-Sébastien will be the last word.
Yeah, so my answer is going to be a bit different, is I don't know. I don't know what's going to be the topic in 2 years. I wish I knew. If anybody knows, please let me know. But I think it comes down to making sure that in risk you have a learning organization that is able to adapt very quickly and learn and position themselves. And so it's a question of behavior. And we always talk about 3 behaviors in risk. We talk about curiosity, so people that really want to understand everything, have a thirst for knowledge. Courage, the ability to take tough decisions. Sometimes you don't want to be popular. And humility. So sometimes you have a great run, but it doesn't mean you're a superstar. It could just be luck. So these 3 things.
Thank you very much for your time. I think we'll bring it to a close. And thank you, panelists, for attending. And thank you for your engagement, for the questions.